Hi friends, welcome back. Yesterday we have completed revaluation reserve treatment. So how will we treat revalued gain and how will we treat revaluation loss and what are the first time rules, what are the second time rules. So today we have a small discussion about the revaluation reserve for subsequent years, because after recognition what we are doing and cost model, revaluation model. In revaluation model, after this treatment in subsequent years what we have to do, that is our agenda to complete this. So post that uh, these one two three concepts are there in after recognition, then derecognition disclosure, these are the only parts pending in this PPE. So if you go to next slide, so this is the treatment we did in the last time. This is the first time, and increase or decrease. What we need to do if we increase and what we need to do decrease. So if the PPE and the first time revaluation increase or decrease. If it is increase, to revaluation surplus account. If it is decrease, direct to P&L account. And this second time increase or decrease. If it is increase, need to see previous time. If previous time also increase, you go to reserves and surplus account directly. If previous time is decrease, in those case check any revaluation surplus account. If increased balance is sufficient to realize that, you recognize other income until the previous year loss and then balance to revaluation surplus account. If it is less than that, most of these increase should be P&L account income only. And if it is decrease, and check again previous year, previous time increase or decrease. If previous time increase, again to the extent of this loss, to cover this revaluation surplus, you cover there and balance will go to P&L. If this time also decrease and decrease, that P&L. This is what we discussed here in every cases, what we need to do and how we account this revaluation surplus at the time of first time revaluation and second time revaluation. I hope you understand this concept. If you have any questions, please go to previous video and check part 7 for this. And then today we will discuss what to do, like once you have an revaluation surplus account, what are the parameters and what are the conditions for us to maintain that revaluation surplus account, I mean utilization of this account. These are two cases. One is on disposal or on derecognition of PPE. On the disposal or the derecognition, the entire balance available in the revaluation surplus account should transfer to retained earnings, not to P&L. So this is the balance sheet to balance sheet adjustment. Revaluation surplus account to retained earnings account balance. What is the balance available on N? On disposal and recognition. So if you are utilizing the revaluation reserve account on disposal or derecognition of the particular PPE, you should transfer that revaluation surplus account to retained earnings. So there is no option for us. So in those situations, you do not need to uh, maintain the surplus account after the derecognition of the PPE, particular PPE which you revalued in the earlier years. You don't need to maintain that account. You should transfer that to retained earnings account. So both are the balance sheet account. You should not do this treatment to P&L directly. You directly give this treatment to retained earnings. So The second case, say suppose you have revalued your asset and you haven't revaluation reserve account, but during that time, I mean during the, say suppose in the first year and second year you did revaluation. Okay, so I will go to the example first, and then we need what we need to do in the subsequent years, and not de-recognize and not dispose of that particular asset. Okay, in those situations we need to analyze. We need to analyze uh, what is the depreciation amount. What is the depreciation amount should transfer to retained earnings to, sorry, to transfer from revaluation surplus account to retained earnings. How should we value that? That we need to check here. First, you listen the examples properly. Say suppose you have valued your PPE, and cost of that particular PPE at the time of recognition should measure at cost rate. So that is 9 lakh. Okay, out of 9 lakh, first the useful life is 10 years. So the first year the depreciation value is 90,000. In the second year the depreciation value is 90,000. So first year entry is depreciation account data to accumulated depreciation or provision for depreciation 90k. The second year also depreciation account data to accumulated depreciation or provision for depreciation 90k. So what is the case for the beginning of the third year beginning, the balances are PPE balance 9 lakhs is your original cost, and accumulated depreciation is 90k plus 90k, 1 lakh 80,000. Your the carrying value is 7 lakh 20,000. So this is what the available information on the third year beginning. In the third year, beginning of the third year, you have revalued your asset. You have revalued your asset. So you increased your revalued asset to 9 lakh 60,000, and useful life is 8 years, because you already consumed 2 years, right? Because 90k plus 90k. So remaining useful life is 8 years, but you revalued your depreciation, your PPE to 9 lakh 60,000. In this situation, your third year depreciation is, assume your following straight line method for 8 years, 1 lakh 20 will come. So what are the general entries for this? General entries are depreciation account, accumulated depreciation account 1 lakh 20,000 to accumulated depreciation or provision for depreciation account 1 lakh 20,000. So what are the balances? Balances is revaluation surplus account from 7 lakh 20 to 9 lakh, from 9 lakh 60. Your carrying value is 7 lakh 20, right? So the difference is 2 lakh 40 is the revaluation reserve account. So so another entry for revaluation is revaluation reserve account data to, sorry, PPE account data to revaluation reserve account 1 lakh 20, 1 lakh 20. So your PPE will increase it to 9 lakh 60 again. Okay, this is your PPE balance, and this is your depreciation entry. So depreciation, accumulated depreciation account is 1 lakh 20. This is the carrying value at the end of the third year, 8 lakh 40. These are the general entries we assume in every transaction, because once you revalued, you should recognize revaluation reserve account and all this, right? So after that general entries in the third year, revaluation surplus account balance is 2 lakh 40, and PPE account you revalued to 9 lakh 60, and accumulated depreciation 1 lakh 20, and your carrying value and net PPE is 8 lakh 40. This is available, and the depreciation account is third one is depreciation account is 1 lakh 20 in the third year. Apart from these general adjustments, you need to do one additional depreciation entry for the revaluation surplus account, because in in the month of third year you revalued, okay, but instead of before revaluation your account is 90,000, okay. Account means your depreciation account is 90,000, but because of this revaluation your depreciation account is increasing to 1 lakh 20,000, because you're increasing your cost, okay. Because of that increase in the cost, your retained earnings, the net after net, the net profit, entire your retained earnings will go to profit and account, surplus or deficit will go to retained earnings, right? So that earnings has decreased by 30K because of this additional depreciation, but your retained earnings should be more than uh, should be this 30,000 less than less this 30,000, because your actual retained earnings is 90,000 only. So your actual depreciation is 90,000. Instead of that, you are reducing from your earnings 1 lakh 20,000. Say suppose you assume that P&L account after the revaluation. These are the revenue 3 crores and expenses 2.9 crores. So your gross or net profit, you can say expenses of everything, net profit 10 lakhs, okay. Out of this 10 lakhs you have a depreciation of 1 lakh 20,000. So your retained earnings is 8 lakhs 80,000, okay. Assume that if you are not revalued, your retained earnings would be 10 lakhs minus 90K. How much it is? 9 lakh 10,000. So from 8 lakhs 80,000 to 9 lakh 10,000, the difference you transfer from the net profit you transfer from P&L account to this account is reducing 30,000 because of the additional depreciation from 1 lakh 20,000 to 90,000 from which is earlier year to this year. Due to this case, your retained earnings are affecting that, the extra 30,000 is sitting in the revaluation surplus account, right? So because of this, you should reduce your revaluation account. What is your revaluation account there? Revaluation surplus account there. 1 lakh 20,000 is your balance. You reduce this additional depreciation. 1 lakh 2290, that is 30K additional depreciation. You reduce from this revaluation surplus account. So revaluation surplus account debtor 30,000 to 2 lakh 40,000. Revaluation surplus account to additional, sorry, depreciate retained excuse me, retained earnings 30,000. By doing this, your retained earnings are showing appropriate balance and eliminating that depreciation surplus, I mean eliminating that revaluation effect also. So you reduce this 30,000, your balance would be 2 lakhs 10,000 at the end of third year after passing this entry. I hope you understand this example. There is only one additional point here, that is additional depreciation entry in the whole example. And you remember one thing, you should not transfer your revaluation account to retained earnings made through P&L account. You should directly transfer to balance sheet adjustment. You should not go to P&L adjustment again because it's already reducing in P&L account. You should not do this. You just transfer this account from revaluation surplus account data to retained earnings. I hope you understand this. uh, for uh, for viewers, I am just repeating the same example, the concept why we need to do the additional depreciation entry. Say suppose, imagine your P&L account, P&L account before revaluation, after revaluation. See, numbers are same. P&L account, say suppose revenue 10 lakhs, 10 lakhs, expenses including direct and indirect all expenses 7 lakh, 7 lakh. So your gross profit and net profit, sorry, net profit, because yeah, including net profit is 3 lakh, 3 lakh. So your depreciation before revaluation it was 90k. After devaluation it was 120k. Net profit is before revaluation 3 lakhs, after revaluation 3 lakhs. So depreciation before revaluation 90,000, after revaluation 1,20,000. So your net profit available to retained earnings is, so assume you have included all taxes and everything. So 1 lakh, 2,10,000 will come here. 1,80,000 will come after revaluation. This is the balance available for retained earnings. So you could you did from P&L account to this will go to retained earnings. In this situation, in after evaluation, instead of 2 lakh 1,000, only 1 lakh 80,000 will go to retained earnings because of the additional depreciation of 30k. This 30k extra cost because of the revaluation is decreasing the retained earnings amount, because instead of 2 lakh 10,000 you are transferring 1 lakh 80,000 only to retained earnings through P&L. So entire your P&L balance will go to retained earnings only, right, in the balance sheet. So that's right. So you're stating that you have an extra cost, but this extra cost, why you incur this extra cost? Because of the revaluation. So you were revalued your asset. So this is a appreciation in the asset, not because of the uh, not because of the incurring extra cost and all. You have incurred only 9 lakhs, and after 2 years the asset value is 8 lakh. After 2 years the value is 7 lakh 20 only, because after the depreciation and everything. But we revalued that asset to 9 lakh 60,000. So the fictitious gain is because of the valuation gain, revalued gain, because that gain is uh, because of the value appreciation in the particular PPE. In that situation, if you assume that one side you are selling I have a gain, but another side you are telling I have increased the cost. So okay, because of your balance sheet value increase, you can increase this cost, but the amount will go to retained earnings amount is also reducing from 2 lakh 10,000 to 1 lakh 80,000. This is incorrect because the retained earnings will go to equity shareholders, right? So they will ask, boss, you revalued your asset and you increased your expenses and you're decreasing our profits. So One in a way you are saying you are increasing your benefit, because the gain. And the second you are saying your earnings are reducing because of the extra cost. The shareholders will disappoint if you do this. Not only for shareholders, this is not justice also. That is why India is saying that because of this additional depreciation 30K, because of this revaluation, because of this revaluation treatment, you should treat this as an additional depreciation entry for this 30K. What we need to pass that time? Retained revaluation surplus account 30K to retained earnings. So if you pass this entry, your revaluation surplus will reduce from 2 lakh 40 to this 30K added here. So again the retained earnings will come to 2 lakh 10,000. So both will same here. So equity shareholders will feel that in both cases we are getting 2 lakh 10,000 only. There is no pressure on the equity retained earnings because of the revaluation. So to eliminate these kind of adjustments, India is proposing this additional entry. Then only that the accounts will be appropriate for the calculation purpose. I hope you understand why India is 16 asking to pass that additional depreciation entry from revaluation account data to retained earnings account. I hope you understand this. So I today I completed this revaluation surplus account treatment utilization and the disposal. You directly transfer to retained earnings. If not disposal, and during the usage of that PPE, you have to transfer the additional depreciation. How you calculate that additional depreciation is the old depreciation and new depreciation. You calculate that this depreciation amount should transfer to retained earnings, then directly to the balance sheet account, not in P&L treatment for that extra 30K, because that 30K already included in P&L through additional depreciation account. So I hope you understand. In the next class, I will discuss about depreciation. So till now we calculated depreciation uh, on the cost divided by useful life, right? So what is the actual cost of actual depreciation formula, and what are the treatment of the asset lives, and how do you treat that, and what are the points to review while calculating the depreciation, and what are the differences of this in the AS and normal regular AS, and between IFRS and all, we'll discuss in the next classes. I hope you understand this. Thank you. If you feel we are putting minimum efforts to you to provide this standard, please subscribe and like and share to the students who require these classes. Thank you.